Okay, so welcome everybody to this month's Tax Huddle webinar. Thank you for hopping on. I really appreciate it. I think there was some confusion on the time from our end, so I apologize for that if you might have gotten the wrong time. But we're here now, so we are going to proceed with this month's webinar. So, a very important topic we're going to be talking about today. We're going to be talking about depreciation of rental properties.
Another year, another pile, numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
Whenever I do a financial review for a client, which is our very first step to becoming a client with our firm, is doing our financial review. This is one of the most common errors that I see on the tax return is the depreciation, whether it was calculated incorrectly by the previous accountant or it was not included at all. So let's start. So who am I? Why in the world should you be listening to me? My name is Jason Malabute, real estate investor, done single family, multifamily, invested out of state. I'm also a CPA. I've been doing accounting and tax since 2013. I've been a CPA since 2015. I'm also a certified tax coach, which is just a fancy word for I do tax planning for clients, and I have training to do tax planning for clients. We save clients an average of about tens of thousands of dollars in taxes through our tax plan. So let's proceed here. So pay attention to today's webinar because there's going to be a quiz at the end, and if you win, there'll be a special prize. Don't tell anybody, but it will be a free tax assessment. A tax assessment is when we take a look at your previous year's tax return and we give you 1 to 2 free tax tips that could save you tens of thousands of dollars in taxes starting today. So we normally charge a lot of money for that, but if you get this answer correct at the very end and you are chosen, you get it for $0. Free 99, as they say. So let's proceed. So the number one mistake that I see is people don't take depreciation. They think it's optional. Sorry to burst your bubble, but it's not optional. The IRS requires you to take depreciation because when you sell the property, they tax you on depreciation recapture. What is depreciation recapture? It is a tax on the depreciation that you have taken in previous years. So even if you don't take it, the IRS is going to assume that you did take it. So how does that affect your taxes? So if you did not take the depreciation, the IRS is going to assume that you did. So they are going to lower your basis, which is going to increase your capital gains tax. So might as well take it and enjoy tax advantage or tax benefit from it. So another misunderstanding is that land is not depreciated. So why is that? Because the IRS assumes that land lives forever, lasts forever. So that's why it's not depreciated. So whatever portion or value is allocated to land, it's not depreciated. So let's say you have $1 million for a property, and let's say $100,000 is allocated to land. That means that only $900,000 is going to be depreciated. If it's residential, it's 27 and a half years. If it's commercial, it's 39 years, but I'm getting ahead of myself. So here's another example, $1 million purchase price. I've seen land be valued as low as 10%. I've seen land valued as 50% of the purchase price, but typically you're going to be around the 20 to 25% for the land. So here in this example, we have a $1 million purchase and 20% is allocated to land. So $200,000 is not depreciable in this example here. So obviously from a tax planning perspective, if you're trying to do bonus depreciation, cost segregation, you want the land to be as small as possible so you get to depreciate more of the building. But remember, you don't get to make that up, right? You have to check the county records and see how much do they allocate to land. Another place to check is check the appraisal reports as well, you'll sometimes see there how much is allocated to land. So remember, 27.5 years is a depreciation period for residential. Commercial is 39 years. So what makes something commercial is if it's non-residential. Short-term rentals is considered commercial, right? And what makes something a short-term rental is if the average stay in the property for a year is less than 7 days. So when do you start depreciating a property? You start depreciating the property when it's placed in service. When is it placed in service? It's when it is available for rent, basically. So here's a perfect example to illustrate what this all means in real life. So let's say you buy a property in December of 2025, but it's not finished with the renovations and it's not ready to be marketed to tenants until February of 2026. So that means it's not considered placed into service until February of 2026, even though you purchased it in December of 2025. So I put here that you are not allowed, right? You're not allowed to write off entire building costs in year one. The IRS mandates that you capitalize it over multiple years, as we talked about previously. There are some exceptions to this. I want to make this clear. So one thing is the bonus depreciation. As long as you purchase the property after January 19, 2025, then certain parts of the property, mostly the parts of the property that has a useful life of less than 20 years, you can depreciate 100% in year one. Also, another one is qualified manufacturing properties. There's a special new law in the One Big Beautiful Bill Act that allows you to write off entire building costs in year one, as long as you meet certain requirements for the qualified manufacturing property, but that's a conversation for a different webinar. Okay, but I just want you to be aware of that. There are exceptions to this rule right here. So we just said about this accelerated depreciation that this applies to our parts of the building that has a useful life of less than 20 years, so 5, 7, 15 years, mostly a capital improvement. All those you don't have to capitalize over multiple years. You can write it off 100% in year one, as long as you purchase it after January 19, 2025. Okay. So this is great because it can create a paper loss. And if you strategically combine that with either the short-term rental loophole or becoming a real estate professional, or if you make less than $150,000 and then you get the passive activity loss allowance up to $25,000, you could use this paper loss to offset your active income. Because normally, if you don't meet those requirements, passive losses can only offset passive income. Therefore, if you don't meet those requirements, you're not real estate professional. You don't have the requirements to meet a short-term rental loophole, or you make more than $150,000. Then those losses become suspended losses and you can't use them until the property sells. Versus, if you do meet those requirements, you can use those losses to offset your active income, which lowers your taxable income, which lowers your overall tax. That's the advantage there. So if you make less than $100,000, or I should say if you make up to $100,000, you could claim up to $25,000 of passive activity losses to offset your W-2 income or other active income. But that is phased out for every dollar that you make over $100,000, and it's completely phased out once you make $150,000. So here's a prime example. Okay, so let's say your active income is $200,000. Let's say that $200,000 from your W-2 job, and also a Schedule C business, right? Like, let's say you have a side business that's all active income. And let's say you get, in this example, a $40,000 paper loss, right, from your rental. So you could use that to offset your active income, which would lower your taxable income to $160,000. But remember, if you're not a real estate professional, and let's say you don't meet the short-term rental loophole requirements, and let's say you just make less than $100,000. So even though your loss is $40,000, you can only use up to $25,000 to offset your active income. But if you are a real estate professional or you meet a requirement for the short-term rental loophole and that they do have a $40,000 loss, then you could use that entire $40,000 loss to offset your active income. So I just wanted to point out that nuance to you. So we're here, we're almost done, so time for our quiz. So if you get this answer correctly, we're gonna give you a great prize, okay? It's better than a vacation to Hawaii, it's better than a brand new Lamborghini, it's better than all that stuff. You get a free tax assessment with this. So let's see what's the question. When calculating depreciation on a rental property, which property can be depreciated? Ooh, this is a tricky question here. Let's see if you were paying attention. A, can you depreciate the land only? B, can you depreciate the building only? C, can you depreciate both land and building? Or D, can you depreciate neither? This is a tricky question over here. My team did an amazing job of writing this question here. So let's see. Who wants to try and answer this question for a free tax assessment? Let's see. Oh wow, look at that. Dexter Thompson. Dexter Thompson said B, building only. That is correct, Dexter. You have been paying attention. Dexter Thompson, you just won a free tax assessment. So my team is going to be reaching out to you. We're going to be getting your contact information and your availability so we can get that tax assessment set up for you. Okay, Dexter? So congratulations on that. And I'm looking forward to connecting with you, Dexter. So before I finish this webinar, does anybody here have any questions about this? I know that this is a lot of information, there's a lot of moving parts here, but I just want to make sure that I'm answering any questions that you guys might have. Who has some questions here? So here's a question by Samantha. Samantha is asking here, if you forget to record a depreciation for the rental property, do you have to amend the tax return? The answer is no, you don't. You just have to file a special form. It's called a Form 3115. So no, you don't have to. Okay? So Dexter Thompson said, can depreciation create a tax loss even when my property is cash flow positive? Great question, Dexter, and the answer is yes. If your depreciation is big enough, then it can definitely create a paper loss, even though your property is cash flowing, which is great, right? Because now you're getting cash flow, and then at the same time you're getting a tax advantage as well. So that's what's amazing and great about real estate, okay? I'm thankful that I got to answer everybody's questions. Thank you again for hopping on this webinar, and I will see you on the next month's webinar. And remember, don't worry, your accountant handles that. See you guys.
Gather the papers, receipts in a row, punch in the numbers, watch the totals grow. Deductions here, refunds there. You're a tax wizard.